Sylvia, let's start with you. Direxion has ETFs, and they let you take all different views. What exactly are traders and investors doing right now, given all of the market volatility?
So really interesting. Over the last couple of days, we've seen a few things. And the first thing that we've seen is actually in a new ETF, which we often don't see. You know, we launch a product and it tends to be sleepy until people kind of like pick up and get to know it. But we have an ETF called Flight to Safety. That word is all over the TV screen all day long. It's gold. You just had Joe Cavatoni on here. It's gold, utilities, and long-term treasuries in one bundle. And a lot of investors are putting that into their portfolio. And what's great about that is they're looking for not only a hedge in the short term, but they're sort of realizing, like, I wasn't prepared. It's hard to hedge. It's hard to figure out when to do this. You stick that in there, participate in market appreciation, but also protect during downturns.
But Sylvia, I mean, this trend has been intact for a long time now. The utilities, the staples, the gold, the long-term treasuries. I mean, is it perhaps a little overdone at this point?
Well, so that's exactly the point. It's been going on for a long time, and I think that people try to sort of strategically hedge with volatility products or other short-term tactical trades, and that's great. You just have to have a sense of when to do that. But I think in the long term, you know, you participate in those trades because they do appreciate over time and you get some yield. You know, where can you find yield in the markets? There's a little bit there. The other thing is look at bear funds in the short term. You know, if you look at high beta bear funds, if you look at internet bear funds, technology bear funds, in the last couple of days, they've returned double digits. So if you're short-term tactical and you have that risk appetite, it's a great way to generate alpha.
I love that you just brought that up because we have Joel on the other side of this, particular barbell in the market. So Joel, tech, media, telecom, communication services, this is your wheelhouse. They were leadership for quite some time, and now they've become the biggest laggards. Is it worrisome to you as a trader of these types of stocks?
Yeah, good morning. Yeah, 100%. I mean, I think for me, just from a trading perspective, you know, look at us just 8 days ago, the NASDAQ was making fresh highs. And that was very troubling. The market completely shrugged off Apple's warning on President's Day. Even NVIDIA jumped 6% last Wednesday on the back of a capitulation upgrade, all kind of flashing signals to me. And it's amazing with the whole coronavirus. Now, finally, the spread of it outside of China has kind of woken up a lot of people that, hey, this isn't contained. The supply chain is going to face serious disruption for the foreseeable future. And end of the day, especially look at the semiconductor stocks, a lot of people priced in a sharp recovery in Q2. There is zero shot of a V-shaped recovery happening anytime soon. And I think you're going to see, you know, anytime you see market uncertainty, at least a fear and a little bit of panic.
Wait.
We've definitely
Joel,
been seeing that the past few
Joel,
days.
0% chance of a V-shaped recovery? I'm skeptical only because the last 9 or 10 years have seen a lot of V-shaped recoveries. Yeah. Why is it different this time?
Well, I just think obviously the world right now, especially the tech supply chain, is focused in Asia. That's just a fact. You look at Apple's warning. Microsoft cut their guidance last night. We've had a couple other smaller names kind of warn, Jabil and Amphenol. The confessions are going to rise. We'll see if Morgan Stanley's big TMT conference still goes on next week. But companies are going to use this platform to kind of come out and cut their numbers. And they have to, because right now, there's just really no visibility. And I think that's the problem with the market right now. And there's really just no bid for a lot of these stocks. What we are seeing, though, there's still a very high preference for high quality, for secular winners. So whether it's Facebook, Google, names like Adobe, other selective names in the cloud complex. But as far as semiconductors, hardware, communication equipment, there's just no bid for these stocks at the moment until kind of the situation, clears up a little bit.
All right, Sylvia, let's bring this back to this idea. There's no bid out there. Is there anything out there that worries you when you see the market dynamic developing the way that it is? Is something giving you a moment of pause? You're saying, well, this time could be different. It might not just be some V-shaped recovery like we've seen for the better part of 7 to 9 years now.
Right. So I'm probably more on the camp of the V-shaped recovery or maybe a U-shaped recovery. I think that, you know, we have these natural disasters. This is a little bit different. But oftentimes in subsequent quarters, we do see a pickup. So, you know, do I think Q1 and Q2 will slow down? Probably. Definitely. We have the technology companies coming out there saying so, and they're essentially leading the market. But if you're a long-term investor and you have a 10-year time horizon, a lot of these stocks are on sale right now. You know, does it give me pause? Yes, you'll probably see volatility in your portfolio. You know, we're definitely seeing pull downs and whatnot, but, you know, you don't really sell in this type of market. And if you sort of have the money and the wherewithal to invest in the long term, it might be a good time to look at things like semiconductors and technology that are being banged up and will still probably set to recover as, some of these issues sort out with coronavirus and China and globalization sort of gets back on track.
All right. Hey, we are down now, implied 300 points for the Dow. Joel, we have just a couple seconds left here. Is this a situation where you're targeting a level to get in on if you want to buy the dip?
I think I'm looking for maybe a break of 3,000 in the S&P, maybe get down to the 2,900 level.
Okay.
But right now, I think that data points, whether it's automotive, industrial, will continue to deteriorate in the near term when the data starts to trickle out.
Gotcha.